this is what we've been working on. Welcome back. This is our quarterly roundtable, mid-quarter roundtable, I should say, for February. Our last one, we were in the old space and we were doing some Hollywood Squares. Now we actually have an actual space where we can sit together and discuss this stuff. As you can see, it's a work in progress. It'll continue to get better as we move along. So we still call it the roundtable. I think we got a rectangle table, so we're working our way toward the round table.
Good enough. It's good enough. It
works.
It works. Spot.
Yeah, it's pretty good. So I think this will be a better format, though, and we're excited about the things we can do in here. Just the way we can interact together, interact with guests. We'll have lots of stuff to roll out over the next year and beyond. But really excited about the new format. So we'll kind of kick it off with where we've been. Obviously, we moved spaces and we've got all this done, but the market's been going at the same time. So from last quarter round or mid-quarter roundtable, which was mid-November, until now, market's done pretty well. Give you a couple of numbers. Dow's up about 12%. S&P's up 13. The NASDAQ's up about 13, closer to 14. Your international, your MSCI World is up about 8. And then even bonds have done better with rate yields coming down. So the ag's up 3%. Commodities are the only thing that's struggled, down about 3.5%. You're always going to have some push and pull. But year to date, again, so that was mid-November till now. Year to date, obviously we've got in first 2 months of the year. The Dow's up about close to 4. S&P getting close to 7%. NASDAQ about the same, right about 7%. And then your international is only at about 1. The ag is retreated a little bit. It's down about 2% for the year. And then commodities down about 1% for the year. So that's kind of where we stand, year to date and since the last roundtable.
It's pretty crazy, man. It's pretty resilient. I mean, everyone's waiting for the shoe to drop, waiting for these markets to correct, and they're not ready.
I think what was interesting about that too is if you remember the first half of the year, it was 6-7 stocks really driving the entire index. Where if you're looking at the S&P 500, it's up 17%. You look at the Dow, it's up like 4%. And so we really had that last 2 months or so of the year, full participation across the board in the S&P and getting a more of a balanced return out of both growth and value for that last bit of the year there.
A surprise to me, though, thus far, a lot of us have been waiting or putting the weight on the returns of the market based upon the anticipation of them cutting rates. And then Jerome Powell comes out and says, we're probably not going to cut rates, and the market goes up.
Yep.
So
well, not that day.
Not that day. The next
you get
day.
a little hiccup, and then
It went down
wait
for
a minute.
24 hours.
Why are we walking away from these really, really profitable companies? Let's buy them back. And it's crazy.
And also, we keep waiting for some reversion to the mean that, mega cap stocks and large tech stocks aren't going to keep driving everything, but they just continue, tech and growth, and it continues to drive it forward. It'll happen at some point, but it's interesting how Jason said for many times on here, the most anticipated recession that hasn't happened yet, and tech stocks and the mega cap stocks continue to drive the market forward.
Speaking of tech stocks, we've had an addition to one of the oldest indexes in the country, the Dow Jones. They don't add names to the third in the index very often, but the one they put in was Amazon. When did Amazon IPO? 15 years ago?
IPO? I'll look, but I think it was right around 2000, 2001, something like that.
And they're finally getting added. The stock's up 180,000%, and they just got added. So the Dow
That's
Jones.
all it takes? 180,000%, you get added?
I'm going to pull the chart up here.
May 15th, 97.
Shows the list of all the Dow stocks. And so some information for our listeners here. The Dow Jones and the S&P 500 are the two indexes that most of you hear mentioned on the news on a regular basis, and they're absolutely different. The Dow Jones, the older index, is a index of 30 stocks. Who selects these, by the way? You'd think I'd know that.
There's like a Dow committee, Dow S&P committee. No kidding.
No,
it's
one
of
behind the curtain.
It's
We're
one
not
of the
really
biggest
sure.
jokes.
We're not really sure what they're going off of.
Well,
Or why.
The point is that why I think it's a big joke is everybody talks about it. Oh, it's an index, it's a basket, it's an unmanaged basket. No, it's definitely managed. They pop stocks in there in and out from time to time based on what? Based on the fact that a company IPO'd in 97 at 7 cents, and now it's whatever it is. And
For
it's a
some
good time,
reason, they're good enough.
Good time to put them in.
Well,
and
without
take
it,
out
they couldn't
Walgreens.
keep up, so they had to add it.
Yeah, no, it's
So I'm
pretty
going to
wild.
pull that right back up. There's a couple things that I want to show on there that what makes these indexes so different. the index, and this might have made sense in 1905. Now it doesn't make a lot of sense. But what this index does, of the 30 stocks that are in there, they, rather than weighting them by the size of the company, they're weighting them by the price of the company, which is
Price per share.
Price per share.
the price per
stock.
share, not even the market cap, but just what the ticker is trading at, meaning whether or not a company has decided to split or not will affect their weighting in the index. And so United Health, which is trading at $525 a share, actually has the largest weighting in the index, almost 9%, even though they're by no means the biggest company, because you can look at the biggest company in here is, well, let's take it like Apple. Being that Apple's only $180 a share, they're only halfway down the index. And so it's, I don't know. It's not the most accurate index, in my opinion, compared to something like the S&P that is actually weighted by size of the companies. This is just weighted based upon whether or not they decided to split.
Yeah, this is one of those we've always done it this way. So it's continued forever, and it doesn't really make a lot of sense. But, people have quoted the Dow for ages, so it just continues.
But you contrast that too. You mentioned the S&P, and it's more just size weighted. You look at the top 6 or 7 stocks in the S&P. There's 500 companies, and there's 6 or 7 make up 30% of the entire index. Right. So
well, and I get that, but I mean, you look at this index, and it's just kind of ironic that Caterpillar has a bigger influence on this market than Apple Computer. When you think of how many people that we know own a tractor versus an iPhone.
I guess it depends on where you're at in the country.
Moving on. Okay, where are we at? Fed funds.
Fed funds rate. So the market's pricing in, again, this has been the theme, right? Market's pricing in 3 to 4 rate cuts in 2024. It's down from 5 to 6, which you would think would slow the market down. A lot of what's going on in the market is anticipation of rate cuts, but it slows for a second and then it continues forward. So you can kind of see with the Fed funds rate chart. This is the one thing that people should recognize is that where we're at with the Fed funds is we haven't been here in 10 years. I mean, we had a brief period where we were up around 2%, but the 5% rate, 5.25%, I think it's 5.33 right now, is pretty unique, and you have to go all the way back to 2007, I believe, to get back to 5% Fed funds rate.
Well, that's different than what we were seeing at our last roundtable too, and they were still pricing potentially 1 hike or 2 hikes, and then a pause, and now we're talking potential cuts this year.
Right. And then the thing that drives this is inflation, which is at 3 to 3.7% since June of 23. So we're kind of floating in those low to mid threes. It's down from a high of 9.1% in June of 22. So inflation has come back down, but now it's kind of hovering in that 3 to 4%. I know the Fed's target is 2 to 3%. So it's always interesting to see what they're going to do they're probably not going to cut rates unless you get some problems in the economy, because they're still trying to get that inflation number down.
Check your I-bonds rates. Those are not very high anymore.
What happened to those?
Those are not very high.
Yeah, all that work, $5,000, $10,000, and now they're not paying very well. Yeah. The one thing I did want to show on CPI on inflation is that you see these low numbers like 3%, 3.5%, and Jason mentioned earlier, at least offline, that people think, oh, inflation's come down, well, prices haven't gone up. Well, prices always go up, and the problem with inflation is when you get a big periods of inflation, it's a compounding effect. So you can see that over the last 3 years, different chart there, cumulative CPI, you can see that prices are up 17%, which is a big deal. I mean,
That's insane.
Yeah, I mean, 17%.
That's what we feel, right? And
Yeah.
clients talk about, well, inflation's coming down. The number went from 3.5 to 3.1 or 3.8. No, it hasn't.
The growth rate is coming down.
That's the
Exactly.
trick. People see on the headlines that inflation's coming down.
Is
That's spoken everywhere by politicians too. Inflation's coming down. No,
Well,
it's just
a
going
trick,
up less.
It's a trick by
going up less.
design. It's
Yeah.
a trick by
And
design.
this shows it right there.
Yeah, and I mean, everyone feels like, well, prices are up 3%. I mean, I could afford a 3%, price increase, but it's that 3 on 3 on 3 on 5 on 9, and then, like I said, prices are up 17%. You start penciling out what you're paying for gas, and 17% more, groceries 17% more.
But does a TV cost more?
TV is actually down.
Yeah,
So,
TV's down.
yeah.
Fuel prices over probably a year ago are actually down. There's a few things, but bread's not down.
Oh, that's the thing. Most of the things when it comes to a grocery store thing, they don't usually come down. Once they
don't
raise the
come
price,
down.
hey, great, we can get this. We'll keep getting this price, and then they'll
Absolutely.
raise it. But home prices fluctuate. Gas fluctuates.
Good segue. You
technology.
mentioned homes. I want to pull something up because the big ticket items that people buy are cars and homes, and home prices. I've got a chart here showing historical home prices. This is going back to, my gosh, late 1800s. But what it's going to show here, a lot of the return in the price of a home, being that it is a physical asset, it's obviously going to be driven by supply and how many homes are available. But what we're also going to see is going to drive the price of a home is cost of goods, cost to build a home, and so they're linked to inflation.
Labor.
That too, wages, everything like that. So they're really linked to inflation. So you can see that home prices have gone pretty much straight up for the last solid decade. And where we feel this though, the next chart I've got is actually showing the affordability of it. So now that the home prices have gone up so much, and now at the same time that rates, what are mortgages at now? 7?
Come
like
down.
that?
Come down to 7.
Come down to 7. So you can see on this chart what it's actually costing folks. So the price of homes in blue, the actual affordability of it has come down in the red. So this is the least affordable homes have been since right around the peak of 2007. And so that's where we see people having a tough time for sure trying to get in a house. That's why we're seeing a lot of people sitting in rentals because they can't afford a home.
Well, it is the same story. But part of the reason that people don't want to sell their homes, the typical sort of upgrade. Okay, we have equity in this house. Let's go ahead and upgrade. You're getting people that are rolling out of sub 4. I'm probably being generous. A lot of them are sub 3% rates, and they don't want to swap that out for a 7% rate. It really should do the numbers, but if you're borrowing, let's say $500,000, that's your mortgage size, and you're paying a payment based on a 2 3/4 or 3% rate. For the same thing right now, you're only going to be able to borrow about $300,000 for the same payment.
Well, and the
because
appreciation
because
of
rates
the
have moved
homes
up.
too, right? You're not necessarily getting a major upgrade from where you were.
Right.
So
But if you locked into that rate 6-7 years ago, you probably have some decent equity that based on the chart you just said and you showed you got some movement up, and especially in coastal areas. Same thing, West Coast, East Coast. It may not be this way in Des Moines, but it certainly is in California and probably Massachusetts. You're swapping out, and you're going to still need to borrow money to go into your next deal. You're going to either really, really crank your payment up, which not a lot of people want to do, or you're going to borrow less money. And so
Put all your equity in.
You really can't make a deal happen with, from a traditional standpoint where you're coming out of about the same rate and going about into the same rate, in your next deal. So I think it's, we all have clients that are based in real estate. It's tough to go find listings, and it's tough to go find, sometimes it's tough to go find buyers right now. So it's slowed down that part of housing.
So segue from mortgage rates, which again are very tied to fixed income rates, because one's a borrower, when you're an investor. So the one positive thing is fixed income rates are up, and so fixed income investors, your conservative investors, or even conservative parts of your portfolio, you can actually generate return on. So we still do have a slightly inverted yield curve. In other words, the front end of the yield curve is a little bit higher than the longer end, but all the way out over 30 years, we got that chart. You can see that you can basically get 4.3% all the way out on treasuries from any time period, from 3 months, 6 months, 9 months. You can see at the top all the way out to 30 years. So that's a big difference from what we've had in the past. And the one thing that wanted to point out, because this is what we're doing for clients, is treasuries are paying about the same rate as CDs. And people are comfortable with CDs because they're used to CDs with the bank and all that. But CDs are fully taxable. So, and in California, that's a big deal. So CD rate, you can see at the top, like a 5-year, for example, CD rate's 4.35, treasury rate's 4.315. But the difference when you do the tax equivalent yield, treasury doesn't pay California state tax. So if you're, your 9.3% tax bracket, you're talking about 5.6% tax equivalent yield versus that 4.35%. So it's a big difference. Anything you guys want to add on that?
No, I use those facts and figures quite a bit. The one thing there, there's a lot of math on that page, but if you looked at that closely, one thing you'll notice too, which I think is evident, what we're trying to do, is that this is very rare for people to see that they're going to get paid. If you look at that first column or the first row that says U.S. Treasuries, that 3, 6, and 9 months is paying more than a 30-year, and so that's very, it's very new and very confusing for a lot of investors. Why are they getting paid less to lock their money up for 30 years versus locking it up for 30 days? And the reason behind that, well, I mean, time will tell if it's accurate or not, but the reason behind that is because investors are betting that rates are going down. And so they're willing to lock up further out, knowing that they're getting less money today in the anticipation that they're going to make more money later. And so that's what we're seeing. That's hence that inverted yield curve. You're getting paid less locking it up, but time will tell if you're actually going to end up making more.
But that's where, the whole cash thing comes in, that people are excited about cash rates. But
Right.
as you can see with an inverted yield curve, the market expects rates to be lower later. That's typically the case when you're in a higher rate environment. So if you're in cash, it feels good today, but it may not feel so good in 18 months.
It might be a teaser.
Cash trap.
Yeah.
I've heard somebody call it a cash trap. It's totally true. But
Well,
by
those
the
balances
time
are sitting at highs, right? I mean, the amount of cash on hand right now that people are having and sitting in money
Absolutely.
markets are
Yeah.
near all-time highs.
and it feels pretty good to earn 5. But when they go into a rate cutting cycle, it's not 5 for very long. Boom, boom, boom. You get a couple legs down, and then pretty soon you're looking around going, it's 3. Why don't we go out and, why don't we try to go find something? Oh, well, we missed it.
Yeah.
The 5% 1 year number is no longer 5. It's 3 also.
Yeah.
So
Yeah, and that's by design. I've talked to a lot of people
Sure.
about it, that, how this whole all works is that the Fed and, the government, anybody doesn't have control of inflation. It's sort of a wildfire that you're hoping to tame. And the reason that they raise rates is to encourage people to keep money in cash, not put money in the market, not put money into businesses, not put money into into circulation. And that, by definition, should help lower inflation. So they're giving you incentive to do this. Not saying it's a bad idea, because everyone likes to earn 5% on cash, but at the same time, it's a temporary solution that when they don't want to give incentive anymore, and the economy's not doing as well, that's where rates start getting cut. That's where your cash rate starts getting cut, and then they're doing the opposite. They're incentivizing you to put money into projects, to put money into the economy, and stimulate. So it's a tool. You just got to know how it works.
100%.
One thing that's kind of interesting that's been in the news a decent amount, and I find kind of fascinating. We talked about this a little bit on Monthly Market Matters. I think Chris and I did in January. Is population of China. So China is obviously was basically the talk probably 10 years ago that Chinese economy was going to overtake everything, and China was going to be the number one source of GDP in the world. And China has since had 10 years of poor stock market performance. But the bigger thing that's interesting is the population of China started to decline. So saw recently where they have 1.4 billion people. I think they're second in the world to India, I believe. But their 1.4 billion people is expected to be 525 million in 2100. I know that seems like a long ways away, but that's 2 generations. You're talking about less than 80 years, and that's a 63% decline. So the whole being able to keep up your population base, requires a certain fertility rate. I think it's 2.1 to be exact, and China's down to 1.09. So for years they had that one-child policy. They had too many people, couldn't feed them, all the problems that they had, and so now they're exactly on the opposite end with super low fertility rate. In other words, for fertility rate, if everyone's not following, that's basically every woman's having basically one child. And so obviously it takes man and a woman to have a child. So if you only have one, that's 2 people dying and 1 person living. So you can't keep up your population that way.
I don't think India is having the same problem. And so I think theirs is still, because I think they overtook China. Is that what you said?
Yeah, I think they did.
Yeah. And now, and they're still on the incline. Because they didn't have the one-child rule.
Overtook them in population?
Yeah.
I didn't know that.
I think you
Looking
did.
at it right now.
And then what did you say? We were talking the other day. Who said the apartments? How many apartments were empty?
I think that was on 60 Minutes this last weekend. I think it was 84 million apartments. Open apartments. That's a lot of apartments.
Yeah. So I guess the important part here is, and the last thing I heard too was the youth unemployment rate when they were reporting it was 25%. So again, there's no jobs. You got 25% of your youth unemployed. That's definitely a bad sign for the future and what's to come. And the reason we bring it up is just because, I mean, it could have ripple effects through through the markets, through world economy. I mean, China was growing at a rapid rate and providing a lot to the world, and now all of a sudden they're completely on an opposite path. And if they continue on this path, I mean, if they continue to lose population year after year, China's going to be a very difficult place.
Well,
And they're still
from
a
an
major supplier too.
a huge supplier, but from an investment standpoint too, it's Chinese investments have not worked out very good for U.S. investors recently. They just
Right.
haven't. I mean,
Right.
for whatever reason, whether you could say it's government intervention, you could see it's competitiveness or whatever it happens to be, it's not been great. So is it they're in a negative 10-year? I think you said their
For
chart
10
is
years.
negative for 10
Yeah.
years at this point.
The other thing too is I think we were talking about the other day was for the first time in a long time, I think net investment in China is now negative. There's more money going out of China than into China. So huge. They said everyone knows that Chinese
Buying up U.S. real estate.
maybe.
That too.
Well,
Online.
I mean, I think it goes more to they're probably not very confident in the value of their currency. We're still a communist country, and government controls it. And then you have communist countries are a little better when things are going good. Not that
Right.
I love communism, but when things are prosperous, like hey, all this thing, it all works out, right? But when you have negative population growth,
Scarcity.
negative economy, scarcity, and then the government starts doing funny things with the currency, you're probably a little more comfortable in dollars. So
Treasuries.
treasuries, exactly.
U.S.
Back to treasuries.
So we always get into top questions from clients. So I had this one the other day, and I wanted to bring it up, and we won't get into every little detail of what could happen, but seminars. So seminars for annuities, life insurance. Annuities, life insurance, they're both insurance products. Is it a good idea? These things always sound really good. I'll tell you this. The first thing is trade-offs. Again, there is no magic product. If there was one product that was the best thing for everybody, that's
do it.
That's what we would do for everybody. I mean, it's simple, right? But in this particular case, they have one product. They say it's the best for everybody. And it's the difference between ongoing financial management and really understanding somebody's situation and continuing to react to it over a long period of time and a product sale. And, buying a car is a product sale. You buy the car, you drive off the lot, you got it. Now you can go back and get maintenance on it and pay more and, do other things, but that's a product sale. So anything from an insurance company is a product sale.
I think a tell on that too, if anyone ever went to one of these dinners, why are they offering the exact same investment to the 35-year-old and the 75-year-old without even asking them
'Cause it's the best.
what's going on?
It's the best for everybody.
Everybody knows it's the best.
Yeah.
That's a little hammer in the nail thing, right?
And the thing is that, just right off the bat, again, we don't have to dissect every product. There is no great magic product. So I don't care what they say, whether it's universal, variable, tax deferred, borrow from your own money, they're on and on and on, all these benefits. There's always drawbacks. The first drawback is they're expensive. And whether you know that or not, insurance costs money. So they have to have an expense built in for the case that you actually pass away. So right there, they're more expensive than a like product outside of an insurance product. Then there's other downsides as well that typically aren't brought up. Like I said, I just mentioned expense. Anything inside like an annuity product would be ordinary income versus capital gains. It's also last in, first out. So you build up all this money in annuity where you defer tax. Well, when you take it out, it's ordinary income and you get all the growth out first. You don't get to take any of the basis out. So it's all taxable until you get back to your original investment. You got surrender charges. So again, this is the difference between product sale and management, right? So the agent is selling the product. The insurance company receives the proceeds. That's who you get the product from. But the agent gets paid. And you may not know it, but the agent gets paid from the insurance company. Well, the insurance company is not going to pay the agent and then let you just walk away and say, hey, I didn't like this product like 6 months or a year later and basically be out money. Insurance companies don't exist to lose money. They're actually very, very good at making money. Mm-hmm. So there's surrender charges. And the surrender charges are basically what the insurance company paid the agent to sell you the product. So again, listen, me personally, I would never go to a seminar and buy something from a seminar. But if you are going to those and you are listening to them, Not that there's not positive things about those products. And in some situations, maybe it could make sense for a client.
Well, full disclaimer too, we're licensed to sell these. So we're not talking against them because it's competition in that sense. I mean, we can do them too. It's just it's a very square peg, square hole.
I sat in front of a client or a potential client the other day, and just said very plainly, because this is how we are: we can sell these. I'm not going to sell it to you, like just straight up. I'm not going to do it because it's not right for you. And number one, it's liability, but just conscience and morals. I'm not doing it. Like, they've told you how great this is. It's not the right thing for you. It gave him, a couple of reasons why, and he appreciated it. It wasn't that, wasn't a lot of pushback, but it's like, we don't have a giant hammer running around hitting everybody over the head. Everything's a nail.
Along those lines though too, I think the biggest difference too is when you go to these seminars, you're targeting people that are retiring or recently retired, and it's an all or none approach. So
For sure.
It's not just a square peg, square hole. It's also not all your eggs in one basket, right? So it may make sense for some people with a portion of your money, but because of the things that you just listed with surrender charges, liquidity issues, taking your entire 401k and rolling it into annuity is probably not going to be the best option for you.
It can be a great option. It just has to be the perfect option and to fit in with the rest
Perfect
of the
situation.
plan.
Yeah.
It has to be, because like you said, if everybody just is the one thing to do, okay, everybody just does the one thing and we're all set. But you give up so much that and Adam says this all the time, you don't realize how important a couple of those factors are until you need to get money out of it.
Yeah.
And you have no access to it. And then to be fair, in this particular client's case, they had a massive amount of guaranteed income, pension income, all kinds of different things. And the last thing they needed to do was lock up the last bit of money that they had liquidity with and throw it into another insurance policy, so they have no liquidity anywhere in their plan. And that was why I think you came down so hard on it, because it makes zero sense in that particular case. Now, if you had somebody else who wanted more, wanted to have guaranteed income, didn't have much guaranteed income, and they're trying to set up a stream of payments, maybe you can make some of these things make sense for sure. But they're not a fix-all. And
that goes back to, like you said, if you're sitting in
that
a room,
particular situation was terrible.
sitting in a room with 30, 35 people, all different ages, all different lifestyles, all different financial situations, and you got one solution.
But they all got the filet mignon.
Yeah, true.
They did get the flame. Yeah.
Open bar too.
Well, the biggest thing, I think we've said this before too. Insurance, and I will say this till the day I die. Insurance is for insurance. I've never bought an insurance policy in my life that I hope to use. If you're buying insurance and hoping to use it, you're not looking at it the right way. I don't buy car insurance and hope to wreck my car and have to use a car insurance or home insurance. It's surely not life insurance. So if you're buying life insurance thinking it's an investment, you could do just as good. You could do better outside the insurance product. So insurance is for insurance. If you have something to protect, it serves a purpose. It could be for estate tax planning. There's lots of reasons to have insurance, just not as, I'm going to use I'm going to use this money as an investment. I'm going to put it in an insurance policy. Just doesn't make sense.
Yeah, no question.
All
So
right,
other questions?
I had one, and I guess we could have brought it up a little bit during the fixed income thing, but I think it's come up more and more over the last year, and it's with rates where they're at 5%. Why don't I just pull my money out and put it in a money market or a CD and collect 5%? I don't have to worry about the markets. I don't have to worry about the uncertainty, and I just collect 5%. That sounds like a pretty good idea, right?
But Kyle, what if rates go down?
Well, they're locking it up, right? We're going to do it for 30 years if you want. But it goes back to what we were talking about, too. It's a combination of things. One, usually if we're doing planning, most clients cannot plan to return 5% on their entire nest egg for the rest of their life and outpace inflation and spending, right? And so there has to be other components to the portfolio. So that's one. Two, it's when to get in and out, right? So rates are at 5, so I'm going to get out of the market. I'm going to go into 5% money market, CDs, treasuries, whatever it may be. Well, then when rates go down, I'm going back into the market. Well, the market's probably appreciated. So now we're buying back in at a higher price too. And then just kind of, I got a little slide here that I'll pull up here with kind of inflation adjusted returns, right? And so as you can see here, both over a 2023, you have your cash in a mattress or coffee can, whatever you want to put it, your T-bill, bonds, and then stocks. And just over the course of 2023 for a year, the inflation adjusted of $100,000, you can see a significant difference between stocks and even bonds versus your cash in the mattress and the T-bill. But if you expanded that over a 30-year period, your cash is your $100,000 is worth roughly 47,000, and that's just based on inflation that we already talked about. And then your bonds, yes, you had positive returns of 55,000 over that period, but again, may not be enough. And then you look at what the stock market is over 866,000. So again, not putting everything in the stock market, but having a plan, having diversified. And then the other part of this is it goes back to the time in the market situation that we talked about over time, right? So staying invested is an important part of investing and part of our planning. And that's, we've joked, I know me and Jason have talked about it, and I think you mentioned on some of these podcasts, is it's our job to try to manage clients and keep clients invested, not bouncing or running the second there's a little bit of spike in the market. And this just shows essentially,
because you get rewarded.
Right. So timing the market's really hard.
Yeah.
The more time you have, the better off you are. But if you're asking me what's going to happen today versus tomorrow, it's a lot harder to predict. And it just shows essentially that same $100,000 going back over 20 years. If you stayed in the market every day, and it's 635,000. But if you just missed the best 20 days, or you're all the way down to 174,000. And so the point is, getting into something that's paying cash now sounds good. It's free or easy money if you think, but that's not always going to be the option, and you still have the potential of how much you're missing out on or leaving. And so again, depends on the situation of the plan, and cash, T-bills, CDs, stuff like that makes sense for portions of money or for certain people, certain situations. But that being, again, the one tool that you're going to use, it's probably not the best solution for majority of clients for majority of their assets.
And again, remember what you're trying to do, whether you're putting money into a 401k or whatever. The primary thing you have to do is to make sure that the dollar that you put in will at least get you $1 worth of goods in the future. So, which is to say, you got to beat inflation, and there's almost zero chance you're going to beat inflation being in cash or treasury bonds. Now, you might beat the market going down. You might beat a couple of things. Over time, you're not going to beat inflation. You can't do it, and so. You get back to, well, what's the best way to beat inflation? If you look at that chart, look at anything, who do you pay your higher prices to? You're paying those typically to Fortune 500 companies. Yeah. So as their profits go up, how do you attach yourself to those profits? Oh, you own stocks. Mm-hmm. And so, yeah, the stocks are probably the only way to beat inflation. Now, but you can people talk about farmland, they talk about timber, but those are really hard to access. It's really easy to access the stock market. It's very cheap, and that's the way traditionally to beat inflation. You just can't do it in cash.
Well, and the important thing is showing those slides is those are 20 years and 30 years, right? So everybody understands inflation today, right? It's been front and center for the last 2 years.
Sure.
6, 7, 8, 9% at one point, and now we're back down to 3.
When's the last time they reduced the price of stamps? I mean, that's an easy one for people to understand.
Eggs,
stamps,
bread, milk.
Well, I think we've said this before, but you go back to like you're talking about in the 80s, you had 15% treasury bonds, and nobody bought them.
Yep.
Because you were afraid that inflation would go to 30. You have massive inflation, and so Kyle's talking about, we talked about earlier that you could get 4.3%, right, in treasuries all the way out to 30 years. It probably makes sense if you want to lock up some return, 4% for some period of time. But if you did, let's just say you put all your money in a 30-year treasury bond for 4.3%, which you may think is enough, right? Hey, if I can get 4%, that's great. But what if inflation goes back up? Now that 4% doesn't feel like 4%, and you've locked yourself in, and you can't get out because the price of that bond goes way down. It's not like you can just jump right back out. So
it's a big assumption too that the government's going to stop printing money. I mean, because that's basically what has to happen.
Right. It doesn't show any signs yet.
I don't think that's happening. Too close to the printing press.
All right, so predictions. This is always a fun part. So I went back, checked our last roundtable predictions. So we had David Lebovitz last time, market strategist. So again, this shows the uncertainty of the market. He's a strategist. He does this, for a living. He said, his prediction was one more rate hike and steeper yield curve inversion. So far, not that it can't happen, but we haven't had the rate hike he talked about in January or February. We didn't get it. We really don't have steeper yield curve inversion. We have basically about the same. It's really a lot flatter.
One thing I'll mention on that too. I mean, David's a great guy, very sharp, very intelligent, but it shows how hard predicting markets can be. And so that's where I kind of remind our clients too. Anytime I get a phone call that says, I heard on TV that they said,
Who's they?
You know, they said the
What did
market's
they
going
say
up.
last time?
They said rates are going down. They said this. They said that. They are guessing. You
Yeah.
know, and so take it not literal.
Yeah.
Because even the experts that we have on can't always get it right either. And so it kind of goes back to Kyle's story of just kind of going for the long term and not trying to pick this thing by the moment. But we'll go with our newest predictions.
So let me read the lower experts predictions. That's us. Jason said rates higher for longer, price pressure on tech stocks. Kyle, value coming back, fixed income strong. I said no rate cuts in 2024, which is obviously we're not through 2024, but that's a
Looking
longer.
good.
Yeah, it's looking good so far. And Chris said value over growth, lower mortgage rates. I did look up the value thing. So value did start out pretty good in November, December. Growth, NVIDIA lately. So growth has done a little bit better than value, but they're pretty close actually from the last roundtable.
And I think too, with value, it's clawed back and performed, or at least participated more than did the first half of last year, right?
Yeah.
So I mean, obviously, its growth is still stronger and outperforming now. But
Do you remember the date of our last roundtable?
I think it was 16th.
November 16th?
Yeah. So yeah, I said it was pretty close with value and growth.
Just
All right,
curious.
what do you got, Jason?
I mean, I'm still sticking with it. I think rates are going to stay here. I think with the amount of money that this country printed during COVID, and as fast as they increased the money supply, we've got these higher rates. I don't think they're going to cut. You know, I kind of lean with Adam on this. I don't know if it'll be no rate cuts, but I think it'll be less rate cuts than what's expected. And even though we haven't seen it here recently, a lot of the, in my opinion, a lot of the growth that we've seen in tech stocks, obviously they're riding the AI wave, but a lot of that is the anticipation of rate cuts. Cheaper money to borrow, things like that. And if we don't get that cut or cuts plural, then I think we will see some pressure on tech. And so I still, that's why, I mean, that's kind of piggybacked into value stocks too. And safer investments. I'm anticipating more volatility this year. We're going to get obviously more calls, and the next podcast will probably be about election and everyone's, you know, it's on front of brain and geopolitical events and things like that. So it wouldn't surprise me if we have some volatility. Doesn't mean things are broken. It just is, it's normal. So that's where I'm going. Rates higher, maybe a little tech pressure and maybe some volatility. So
not higher.
if I'm always wrong, then that means things are going to go
You're not
straight
wrong. You're
up.
just early.
I feel like I've heard this strategy before.
I have definitely heard this strategy.
Not wrong. Just
So
early.
buy NVIDIA.
Don't,
All right, Kyle,
don't
you're
say
up.
that.
I think I'm going to stick with a couple. I still think value is going to have a turnaround. Will it catch growth? I don't know, but I think that the delta, the difference between growth and value will get narrower. I think it'll participate more in the market this year. It won't be this, growth 30, value 10. I think it'll have a better participation in it. I'm still going to stay on my bond one. I think with rates kind of plateauing there, I think it'd be nice to see some, 5-6% principal growth in our bonds.
Mm-hmm.
We've given back quite a bit. We had 3 years in a row of negative bond returns. So I think that will be.
It got rescued last year.
Oh, at the end, So
we
it
ended
was
up plus
2
like
when we were
2
at the end, right?
yeah.
So
Right.
2. But so I'm optimistic for that, and then I'm going to go out on a limb too a little bit and say that I do think that the mortgage rates will continue to come down. I think they were 7.5 a while ago, and now we're down to 7. So I don't think we're getting back to 3 anytime soon. But,
Right.
No.
I do think that's going to.
No, I think the
come
3
down.
days are over for a while.
Yeah.
Chris,
So I obviously missed on value over growth.
but not bad though. It was
but-
close.
Yeah, it was close, but lower mortgage rates, and I think they'll continue to come down. And the people we talk to in the mortgage world, they think they're going to continue to come down. You get 10-year treasury. If you just watch a 10-year treasury, that'll give you a pretty good barometer for what's going to happen. And it's down from right around 5 to heading towards 4. And that's, for home buyers, it's a good thing. That's a super good thing. So, I don't have anything really exciting to add to that. I mean, I think growth is probably in for a break, but they don't seem to be breaking anytime soon. So, which is fine too.
Yeah, so we got like pulling at two forces, right? You keep having this, we're going to have to cut rates eventually. I'm not really sure why, other than, the market has expected lower rates because it's had them for so long. And inflation just doesn't seem to want to get back down below 3. And I know the Fed's really stuck on inflation. The jobs reports come out, everything, data looks strong for the economy. Not that it's the best it's ever been, but it's just not faltering like it needs to. So I still think, I don't want to hedge on it. I still think no rate cuts in 2024. Maybe they do one just because they feel
Election
like
year.
it's election year. They feel like they have to, but I just don't see everything, what it's going to take to cut rates. And they don't have inflation where they need it. The economy's not struggling. Markets are not struggling. So we got 3-4 priced in, down from 5-6, and I still think it's probably 0 or 1.
Well, Federal Reserve
one in September or October.
Right before election.
Yeah.
and he took so much heat for so many years for keeping rates so low. And one of the big arguments was, well, there's no arrows in the quiver. If things get bad,
What
they
else
have
are they
no,
supposed to do?
and if things break down, they got plenty of powder now, and they can really affect rates in a big way. So it's hard to go from 0 to -2 or -3. It happens every once in a while. There's plenty of cases for it, but not here. And again, you don't want that world. You don't want
Well,
the
that's the
world where
thing,
we're
right?
negative
Right.
rates.
We're all waiting for this rate cut, but usually when they're cutting rates, it's because something's wrong, something's bad.
Yeah.
We're in
Exactly.
recession. Things are nasty.
We'll have to have another strategist too, an economist, come on and talk about the way they've changed monetary standards, monetary supply from the scarce reserve
Oh,
policy.
that
to,
sounds really exciting.
yeah, I know. But
I'm busy on
Exhilarating.
that one.
but it's interesting because it used to be a different model with a scarce reserve standard, and now it's an abundant reserve standard. And again, these are all jargon terms. M2 money supply and how that's driven inflation a
I
lot.
just fell asleep.
I know. God.
Close to the mic and snoring. It's not good.
But it's a big driver of inflation. And again, whatever these terms are, and how boring it gets, what drives inflation is what's going to happen in the economy and with the Fed and with the markets. So it's a big factor. And as I said, that's why we keep bumping around in the threes. Money supply is starting to come down. But remember, you don't have to know much to think what happened when COVID hit. Give people money, PPP loans, all these things. That's your money supply. And I think it increased by 60%
Well,
or
and that's the
some
thing.
huge number.
That's the thing. I think when you get some more time away from this and you get 5-10 years out and you look back and go, why do we have so much inflation? It wasn't just a money print thing. It was a scarcity issue also.
Right.
I mean, we could not get goods and services shipped here.
Well, we hit both, right?
Nobody
And
we got-
pent up demand, right? Being stuck home for
and
periods of time.
we get a giant boat stuck in the Suez Canal that screws everything up. And now we got stuff happening over there again where you have the potential to screw up shipping lanes. And so a lot of people are concerned about a lot of those different issues. And it's not just, somebody hit the it was 3 or 4 of those things that all happened at the exact same time. And, our generation has never seen this type of inflation. You had to go back to the 1970s when, none of us were really conscious at the time. And so it's interesting to see how people react to it now, because not a lot of people are decent historians, especially looking at, economics going back very far. They think they are, but, and it's different when you live through it too.
Recency bias.
Yeah, there's no question. No question at all. So
Well-
I got a question.
Yeah.
Has everybody gotten some decent feedback from clients on the new office space?
Yeah, for sure.
Yeah.
Yeah, the office has been great. I mean, just a little more space, said conference room, studio. People like it. We got some furniture coming. Apparently, they have to grow the cows, kill them,
Scarcity.
skin the leather.
Scarcity.
Furniture is, I got to get in the furniture
Well, the
business.
trees are still growing too, so they got to
Yeah.
wait and get.
My next life is furniture business because that seems to be very difficult to get furniture.
Is it difficult to get furniture?
Would you know, Jason?
Yeah, it's difficult to get furniture. Unless you go on Wayfair, they'll get it there in about a week.
Yeah, no kidding. No
Yeah.
kidding. They've somehow have cornered the market on inexpensive.
Price for quality.
No question.
I think overall
Easy to
feedback's
get
been
it.
positive. I think it's more space. It's done nice. It's just waiting on a few little pieces here with furniture, but overall, I think all positive so far.
Yeah,
So.
yeah, me too.
Yeah, and if you're watching this, like we mentioned, Podcast Studios is up and running. It's functional, but it's definitely not where we want it to be. So we'll continue to improve the process.
What's the story with your light over here?
I think that's a prop right now.
All right.
It's not going to be a prop eventually.
It's on.
Right now, it's a prop.
Yeah.
We'll get better at the camera switching, all the things that involved in the studio. And like I said, we got a lot of plans with it, a lot of things we want to do, and I think it'll continue to come together. But we didn't want to wait until. I mean, it's just like anything, right? Like time in the market. Can't wait till it's perfect. Like you got to start getting
Get it
things
going.
going. Yeah, get it going. So,
Sure.
so for clients, reach out to us with questions.
Yeah, that helps feed the podcast. I mean, rather than us just talking to each other, it's nice to have a little bit of direction on what you guys want to hear.
Yeah,
And so
absolutely.
email us, text us, call us. Hey, it'd be neat if you guys talked about this, talked about that. That helps us quite a bit.
Yeah, anything you hear in, on TV, anything you hear from friends, I mean, it's all fair game. There's no dumb question there. So there's a lot to this. So we say that a lot of the same things as far as how many factors influence the market and how you just can't tell which way things are going, but we can't explain how things work and talk about what we see and, kind of go from there. And then, talk about things like universal life insurance because you got to have that.
Well, we might do some one-off podcasts. And so as the requests come in and questions come in, that's where I think we're going to use this room to just have little one-offs that won't be a roundtable, but it just might be two of us talking in more depth about the DSTs, or you can come in and do a monologue about money supply. or
Mono means one.
Yes. or if someone has questions about estate planning, we might just do a one-off little thing about that and have this on a list on our website that people can come just check videos out if they want to a little bit learn more about college planning or things like that. It won't always just be discussion about markets, but highlighted on specific topics.
And I don't think I'll get to the level of, like the button and do all the other stuff they're doing as far as promoting it. But
Oh, my kids would love that.
But chances are, if something on here is informative to you or beneficial, someone would find the same information beneficial. So
I guarantee
it's
everybody
easy to share, and if it's informative or helpful to you, then it will be received well too.
I guarantee everybody has at least one person with massive gain in real estate.
Yep.
It may not be you, but you know somebody, and that's it said. Just having that option and understanding that there are other things that exist is choices are power. Is what I'm trying to say. You get choices give you a lot of power, and that way you can figure out what the best option is for you.
Well, too, and that's another way. We've had clients that have reached out for specific things on a podcast, and we get that an hour-long roundtable may not be ideal to send to a friend or a client on something. But if something comes up in conversation, I remember they talked about that. Just reach out. We can cut it down to that part where you can send them, and it's just the pertinent information for them.
Yep. Yeah, no question.
Well, good. Hey, hopefully everybody appreciated the new format. I think it flows a lot better. It's easier to talk and banter back and forth. We'll do it again here in a couple of months, but in the interim, we'll have some shorter ones with our monthly market matters. And like Jason mentioned, just some, one-off topics so we can get as much information out there as possible.
I think too, if there's guests that you have in mind, we're open to ideas and suggestions too. So bring it on.
Thanks everybody. Really appreciate the time.